Hello, this is Jack Yost, your business professor, and I want to welcome you to Managerial Control, Chapter 14, as part of Management Theory and Practice, Management 323, offered by the Catholic University of America here in Washington, D.C. Mario Andretti, the race car driver, once said, "If you're under control, you're not driving fast enough." Now, Mario Andretti was talking about driving his race car around a track, sliding around corners with a lot of slippage. But one of the things that he was always careful to do most of the time is to keep the greasy side down and the shiny side up. His purpose was to stay within the ditches. So, no matter how fast you're driving your company, our purpose here will be to encourage you to keep you in between the guardrails using some managerial control mechanisms. Let's take a look and see what that looks like. Learning objectives for today is to explain why companies develop control systems for employees. Summarize how to design a basic bureaucratic, and that's a good word, bureaucratic control system. Describe the purposes for using budgets as a control device. Define basic types of financial statements and financial ratios as controls. List procedures for implementing effective control systems. Discuss ways in which market and clan control influence performance. Managerial control is any process that directs the activities of individuals toward the achievement of organizational goals. Signs that a company lacks controls. Let's look at the control process. Figure 14.1. Managerial control. Bureaucratic control. This is the use of rules, regulations, and authority to guide performance. That's bureaucratic control. Market control is control based on the use of pricing mechanisms and economic information to regulate activities within organizations. Clan control, CLAN, is control based on the norms, values, and shared goals and trust among group members. Control systems have 4 steps. Number 1, setting performance standards. Measuring that performance. 3, comparing performance against the standards and determining deviations. Number 4 is taking action to correct problems and reinforce success. Setting performance standards. Standard is an expected performance for a given goal, a target that establishes a desired performance level, motivates performance, and serves as a benchmark against which actual performance is assessed. Measuring performance is done through written reports, oral reports, and personal observation. Comparing the performance with the standard. The principle of exception. A managerial principle stating that control is enhanced by concentrating on the exceptions or significant deviations from the expected result or standard. Bureaucratic control occurs before, during, and after operations. Feedback forward or feed-forward control. The control process used before operations begin, including policies, procedures, and rules designed to ensure that planned activities are carried out properly. Concurrent control. This is the control process used while plans are being carried out, including directing, monitoring, fine-tuning activities as they are performed. Feedback control is the control that focuses on the use of information about previous results to correct deviation from the acceptable standard. The role of Six Sigma. At a Six Sigma level, a process is producing fewer than 3.4 defects per million. That is a very high operation rate of accuracy, nearly 100%. Six Sigma companies have not only close to 0 product or service defects, but also substantially lower production costs and cycle times and much higher levels of customer satisfaction. In Exhibit 14.2, we see the relationship between Sigma level and defects per million opportunities. Management audits control various systems. Management audit is an evaluation of effectiveness and efficiency of various systems within an organization. An external audit is an evaluation conducted by one organization, such as a CPA firm or another outside the organization. An internal audit is a periodic assessment of a company's own planning, organizing, leading, and controlling processes. External audit. Number 1, investigates other organizations for possible merger or acquisition. Number 2, determines the soundness of a company that will be used as a major supplier. Number 3, discovers the strengths and weaknesses of a competitor to maintain or better exploit the competitive advantage of the investigating organization. Internal audit assesses what the company has done for itself. Number two, what it has done for its customers or other recipients of its goods and services. Budgetary controls, budgeting, the process of investigating what is being done and comparing the results with the corresponding budget data to verify accomplishments or remedy the differences, also called budgetary controlling. Sales expense budget is one of them, seen in Exhibit 14.3. There are types of budgets: sales, production, cost, cash, capital, master types of budgets. Accounting audits are procedures used to verify accounting reports and statements. Activity-based costing, or also known as ABC, is a method of cost accounting designed to identify streams of activity, then allocate costs across particular business processes according to the amount of time employees devote to particular activities. A balance sheet as a control mechanism. This is a report that shows the financial picture of a company at a given time, a snapshot, and itemizes assets, liabilities, and stockholders' equity. On the balance sheet, you have assets, the value of various items that the corporation owns; liabilities, the amount that a corporation owes to its various creditors; stockholders' equity, the amount accruing to the corporation's owners; and the simple formula that says assets equals liabilities plus stockholders' equity. Profit and loss statement, P&L statement, is an itemized financial statement of the income and expenses of a company's operations. There's some financial ratios. A current ratio is a liquidity ratio that indicates the extent to which short-term assets can decline and still be adequate to pay short-term liabilities. Debt equity ratio. This is a leverage ratio that indicates the company's ability to meet its long-term financial obligations. Return on investment, ROI. This is the ratio of profit to capital used, or a rate of return from capital. Now, how do we using these financial ratios? Management myopia. This is focusing on short-term earnings and profits at the expense of long-term strategic obligations. Now, bureaucracy is not a bad word, but bureaucratic control has a downside, such as rigid bureaucratic behavior, tactical behavior, and resistance to control. More effective control systems. Systems that are based on valid performance standards. They communicate adequate information to the employees. They are acceptable to the employees. Use multiple approaches. They recognize the relationship between empowerment and control. Balanced scorecard is a control system combining 4 sets of performance measures: financial, customer, business process, and learning and growth. Examples of market control are seen in Exhibit 14.9. Management control in an empowered setting. Putting control where the operation is, using real-time rather than after-the-fact controls. Rebuild the assumptions underlying management control to build on trust rather than distrust. Move to control based on peer norms. Rebuild the incentive systems to reinforce responsiveness and teamwork. Now, let us close in on Chapter 14 on our chapter on control, and hopefully, Lord willing, as you drive your business fast, you will keep your business between the ditches, and make a profit. This is Jack Yost, your business professor, and I look forward to receiving your assignment. Thank you.